We had big numbers out this week on GDP. People got excited. It was a little higher than we thought, but there were some other numbers that maybe suggested softening the economy.
I think that's right, David. The GDP number was looking pretty good, but if you looked at how much of it was inventories, you looked at the internals of it, it looked less strong. And then we got a number this morning on personal spending that was softer than people were expecting. I think the economy is in a very uncertain state. There are favorable numbers and there are rather less favorable numbers, and that's certainly going to complicate the decision-making and the signaling coming into the next Fed meeting.
Well, and that is, of course, as you know well, it's going to be next Tuesday and Wednesday. We hear what they decide on Wednesday. So what do those uncertain numbers tell the Fed? What should it do next Wednesday?
My advice to the Fed, which I think is consistent with the path they're on, is to maintain maximum flexibility in an economy where things could go either way. I suspect they will do 25 basis points on Wednesday, and I hope they will not project confidence about what their future intentions are, because I think there's a lot of uncertainty about the way things are going. If I were sitting at the Fed, Jay Powell has wisely observed that monetary policy works through financial conditions. And if you look at overall financial conditions, they are actually looking like they have moved substantially towards easing in the last several months. So in a way, the monetary impulse that's coming into the economy is much less expansionary, much less contractionary than you would think just looking at federal funds. And that is something that I think needs to concern the Fed as it sets policy. So I don't think this is a time to be taking possibilities of rate hikes off the table. At the same time, I don't think it's a time to be committing to rate hikes, given the indications of softness that we have seen from a number of quarters. So this is going to be a very difficult period through the Fed. They're driving the vehicle on a very, very foggy night. They've got to be doing it looking forward rather than looking out the side window or the back window. But when it's a very foggy night, you shouldn't drive too fast, and you should be ready to hit either the brakes or the accelerator.
So, Larry, as a macroeconomist, you help us look broad. You also help us look long, and you put it in a larger perspective. There is something of a debate going on, as I understand it right now, over the longer term about whether we are in or headed into a higher interest rate period overall, or whether, in fact, we're going to come right back down where we were. And that secular stagnation that you first identified for people may be coming back. As you know, Olivia Blanchard, formerly chief economist at IMF, has a book out now warning about secular stagnation, saying that's the bigger risk right now. I think you may have a bit of a difference with him.
Look, everybody should read Olivier's book, which is terrific. And I think he recasts the debate about fiscal policy in some quite helpful ways, recognizing the potential importance of low interest rates. And I think he lays out an important and plausible scenario where we return to the kind of secular stagnation that he and I and others had emphasized as a feature of the pre-COVID period. My own best guess is that neutral real rates are going to rise relative to the pre-COVID period. That's going to happen for four reasons. It's going to happen because of substantially larger government debts and deficits going forward in many parts of the world. It's going to happen because of substantial increases in investment demand caused by energy transition investments and resilience investments in the private sector. It's going to happen because of the overhang of asset prices, which are high, and the contribution that that makes to spending, which operates to reduce saving and raise real interest rates, something that may be particularly pronounced if, as Charles Goodhart has suggested, the elderly are dissaving, and because there may be some greater tendency to rely on debt finance going forward. My sense is that those factors taken together may outweigh the continuation of the demographic factor and others. But it's a very uncertain situation. But when I look at the Fed's current estimates of a 2.5% long-run neutral rate, I see more room for inflation to settle in a bit above 2, and I see more room for real rates to settle in about above 0.5 than I do for the error to be in the other direction. But Blanchard's is a hugely important book that deserves the attention I'm confident it will get.
We have been struggling with inflation versus growth here in the United States and in much of the Western economy. Latin America also is struggling with its own version of that. We had decisions from the Chilean Central Bank, the Colombian Central Bank this week, and then we had an announcement or a trial balloon of possibly a currency union between Brazil and Argentina. What do you make of that?
If that was a trial balloon, it needs a needle to pop it. That seems to me to be a extraordinary and somewhat bizarre idea. I suspect there will be cynics who would say that Brazil and Argentina having a common currency has a little bit of the character of two drunks in a ditch, hugging themselves for warmth. I'd much rather see them work on liberalizing trade between them, finding ways to make both our economies more fluid.
Larry, you and I were over in Davos last week, and as we both saw, there was a lot of talk about Ukraine. Quite a few representatives from Ukraine there speaking out. And one of the things that you raised, others did as well, that you were particularly eloquent on the question of the need to really have substantial reinvestment in Ukraine to bring it back after this war, but also the need for that to be commensurate with some reform about how they handle their money. Now we see 7 officials in Ukraine having been dismissed by President Zelensky. Are they on the right path? What do they need to do to have credibility?
As important as it is to win the war, it's important to win the peace. And that is a lot about the creation of prosperity and opportunity for those who live in Ukraine. Let's be honest and recognize that even by the very low standard of the 15 republics of the former Soviet Union, Ukraine has performed very poorly economically since the Berlin Wall fell in 1989, and that was true even before there was a Russian threat in 2014. So yes, we need to provide very substantial support. Yes, I think a large part of Ukrainian economic success is going to come from coming together with the rest of Europe on many economic dimensions. But it's going to be very important that financing be provided for investments that take place in appropriate frameworks of integrity, of efficiency in procurement, of targeting.
And finally, Larry, we have this week the Treasury Secretary Janet Yellen going to Africa. And one of the things that she's addressing there is some of the debt overhang, if I can put it that way, in a number of sub-Saharan African countries. It's something you have warned us about here on Wall Street Week and elsewhere about this issue. What will it take to make real progress here?
I think Secretary Yellen is building an important legacy around the developing world. She has pushed for reform of the World Bank. She is going all the way to Africa to highlight the importance of these debt issues. A crucial issue is going to be finding a framework in which the United States and China can cooperate relative to when I worked on these issues and supported President Clinton in the largest debt initiative to that point for the poorest countries. The big difference now is that China and a range of Chinese institutions have emerged as major creditors. And we're going to have to work on finding a way that involves them.